Hi everyone. How is everyone doing today? Hey Supriya.
Hello, how are you, Dana?
I'm good. How have you been?
Oh, good, good. Nothing to complain about.
Awesome. So today is on the flip side, and we are going to be talking about some market updates, hearing a mortgage broker's point of view. Curious to hear what you have to say on all the changes we've been seeing and just getting an idea of what you're seeing. And yeah, so do you want to get us started? What curious to maybe do like a quick overview of what you think what you're seeing with your clients and everything.
Yep, for sure. I think few things before I get to what I'm seeing in terms of clients and all that good stuff is we already know inflation is still really high.
Mm-hmm.
We are seeing that what Feds have done recently in US and even in US, inflation is still out of control. It's still not where we would like to see or where US would like to see. And the same trend is kind of following. Typically, we follow the US trends, whatever is happening there, similar happens here too. Our Canadian dollar is also weak. It's at about, I think, as of Friday, I haven't checked it today, but it was sitting at about 1.38 against USD, which again tells that inflation is still sitting at that highest point. Sure, the gas has kind of come down slightly, but the main consumer products are still expensive. Our groceries are still expensive, and that trickle effect from COVID, supply issue, Ukraine Russia war is still impacting since for the last few months. So that's talking about the inflation. Now, what that does impact is the rate, obviously, right? Like Bank of Canada has consistently raised those rates for the past few months. And the expectation is October 26th is the next announcement coming up. Anywhere between 50 beeps to 75 beeps is what most of the economists or the banks are essentially saying. And then another rate hike expected in December. Now, will that really happen? Probably, because that's the indication that we have also seen from Bank of Canada. Now, the biggest question I think most of my clients and my listeners, I have my podcast as well, they're asking about is when is the rate expected to come down? And quite honestly, nobody has that crystal ball, right? Most of the economists, again, are saying 12 to 18 months it will stay the same. But as a mortgage advisor, I would say that run your worst case scenarios, do your and then, assessment or all the analysis, keeping in mind for 24 months or even a little bit more, because we don't know how long the Russian, Ukraine war will last. We have no idea if this new variant that has just come up a few days ago, how quickly it will spread, what is the impact of it overall. It has really picked up, pace in US, and we are seeing the increase in numbers. Hopefully, no closures or anything like that, but again, you never know. Right. So there's still a lot of volatility. There's still a lot of uncertainty as to how much it will increase, but the definitive answer is that yes, it will increase again in October and December potentially. Just don't know when these rates are expected to come down, right? In terms of the appraisals or the values, we are seeing in some areas that the appraisals are not coming to the client's expectations, obviously. So, again, have backup plans, understand how much down payment, or if you need additional funds, then, have some kind of, I guess, buffer in terms of your numbers. If you're in the market looking for a property, highly recommend to include the financing clause. Again, from due to the values are coming the way they are. I don't have an approximate number, but it really depends upon the area, what kind of property, and all that good stuff, right?
Question for
Uh,
you on that
yes,
actually.
yeah.
For the appraisals, or sorry, for yeah, the appraisals, are you seeing like is it so it doesn't seem like it's happening everywhere, right?
Yeah.
So it's just in certain areas. And also, okay, that's good to know. Because yeah, because a lot of people are saying like it's happening everywhere, and I feel like I'm also not seeing it everywhere. But again, I'm not like you that you get like your clients are all over the place. I'm really, to be honest, I will focus on what I'm interested in, right? And I mean, other people, if they tell me things, then I'll remember it. But I can't say that I know so many areas. Like for you, you're probably,
Yeah. Yeah,
everywhere.
so they're not in every area. It really depends what area it is in, what kind of property it is in, and all that stuff, right?
Does
So
it matter the type of person? And maybe that's the wrong question, in the sense of like, if you're an investor, a first-time home buyer,
no,
does any of that change?
no, that doesn't really matter. Say, for example, I had an appraisal that got done in Kitchener for a property, and let's say the value was 800K for that property. It came bang on at 800K. It was neither less nor higher. So it shows that, and it was a single detached kind of a bungalow, which an investor plans to convert it into a legal duplex later on. So it came about the same price that they had expected to, that they had made the purchase on.
Sorry,
Because,
my question actually I meant was on the mortgage itself. Are they making it harder for people to get mortgages depending on the type
oh,
of
I see.
person?
I'm
Yeah,
sorry.
sorry, that's what I meant.
Misunderstood. Okay.
Mhm.
No, that's not the case. That's really not the case. Definitely, if you're first-time home buyer, then sometimes they will make that extra exception. If GDS, TDS slightly off, then they would consider it understanding the holistic way of the application. But overall, from investors' perspective, in fact, CIBC, I'm from CIBC, so CIBC has actually launched two additional programs for investors, because in regular, way they were not getting qualified. Say, for example, the self-employed program initially was only for first-time home buyers. Now that has been introduced for investment as well. So that's a great
Mhm.
plus, right? Another program, the high value program, which was only for primary residence or secondary properties or vacation properties, is now being introduced for investment properties or rental properties as well, right?
Oh, interesting.
So yeah, and these are some solid programs that I have helped a lot of investors as well, as far as they meet certain criteria. It was shut down in last year in December. So until from December till now, it was not open for investors at all. But now they have opened this again for investors with certain changes in the overall program, which works out really well. So say, for example, if the TDS is running at about close to 60%, 58, 60%, we can get you qualified under this program if you meet certain criteria with 20% down. Okay.
Interesting. Is this something like very recently, like let's say this month kind of a thing?
This Friday, last Friday.
Oh, okay, that makes sense because so that's interesting. So I think some people got stuck in that in between. I felt like in September, October, I know there were some people that were not getting qualified or investors not getting qualified. And it is funny you say that because I did notice, I don't know if it was advertisements, but I was noticing, for example, like that new products coming out in these last couple of weeks, was kind of I did find it very interesting because like that the first like September, October, well, specifically like right after that rate change,
Yeah.
and then maybe like a month after, I was seeing lots of investors that were in that time period kind of getting screwed over, like I can't, like I don't know what to do. But I
Yes.
guess now mortgages have tried to are now helping out a bit more trying to get that. So
Yeah.
I guess we just had a bit of a transition to have to wait.
And another thing that CIBC has done specifically is they, for a 2-year fixed term rate, they have introduced a really special rate for investors, and that's sitting at about 5.24%.
Mhm.
And I've researched throughout the industry, top banks, nobody's offering this rate. And
Mhm.
reason 2-year is good at this point, as we had discussed earlier. We don't expect variable to come down any time less than at least 12 to 18 months, right?
Agreed.
With another rate hike, another 2 rate hikes expected this year, it will go over the fixed rate, at least for that period of time, right? So depending upon if you plan on keeping the property at least for 2 years, then 2 year fixed rate might make sense for some of the clients, right? But then again, variable does give you that flexibility that if you plan to liquidate over the next few months, then you go with that. So depending upon everybody's situation, most of our clients are actually, I'm helping a lot of clients moving from variable from different institutions, bringing on to, they want to lock in, they're done with that many rate hikes. They want to have a stability, I guess, and think about other things in life than just mulling
Stress
about
about the interest going up every single time.
the interest rates, right? So that's what at least I'm really helping out the clients at this point, is educating them and helping them out that, okay, if this is your cash flow, this is where you want to be, then this is how we can structure it. You go with this term, and these are, some of the pros and cons of going with something like that.
Very interesting.
Yeah.
And it's very actually, so it's nice to see that I guess the banks are starting now to make changes and trying to.
I can't talk about other banks, obviously.
That's true.
But
That's
this
true.
is something that CIBC has specifically done, is introduction of 2 programs specifically for, introducing it to investors, because I feel like they also feel the pinch, right? Like if investors, they know investors are ready, it's just a matter of time and finding the right property. They know that they're ready, and for some of them, they will qualify at a higher rate, but for some, they might not. And introduction or expansion of these programs will actually help them get qualified.
Yeah, no, it's great, but it's good to see even like that things are at least getting better. Because like I said, like I just saw this period of time where it felt like it was actually very targeted to investors. And at least with the programs that you're saying, it makes more sense now, because I guess at least CIBC saw that and was like, okay, let's bring back this program that will find, like, our regular one doesn't really work for them anymore, but at least we have another one that helps investors out. Because I was feeling that they were directly impacting, a lot of investors were getting impacted.
Yeah, no, for sure. And especially with such a high stress test, all those numbers, qualification was just not working out, right? But if clients have extra savings in liquid assets or registered assets, then that will play a huge role in terms of getting them qualified under one of these programs.
Oh, interesting. And so I don't know if you want to get into, shall we do some predictions, curious on opinions, and like how we
That's always a tough one to do, right? Nobody, like, okay, think about it this way. Banks pay huge amounts to economists, and Bank of Canada, the governor, obviously they're making a lot of money, but even they were not able to predict anything, right?
Yeah.
They were
Well, sorry, finish.
Yeah, so I was saying that they were unable to predict anything that has happened so far. What we can do is always kind of be prepared for the worst, I guess, and then make decisions accordingly, right?
Yeah, 100%.
Yeah, and that's what I'm advising my clients. Like if they're saying 12 to 18 months, you budget for 24 months, right? And then you run your numbers at slightly higher percentage if you want to be on variable, because if the inflation is still not controllable, who knows? Like they'll probably do another rate hikes next year, right?
Oh,
So
yeah.
take a word on them. You run your numbers, be conservative on every angle, and please do include the financing clause if anybody is making offers.
Actually, okay, so I think a question on the financing clause, which I think probably now it's probably fixed and changed, because now it looks like, at least like you said in CIBC, things are changing. But like that, in that small period of time, people were getting approved, or I guess it's always conditional with the banks, conditionally, like you're approved, but technically I guess you're kind of not. And then like that, like once you're getting close to closing, some I was hearing they're actually dropping it and then they weren't getting approved after the finance clause already was removed.
It
Have
depends. Okay, so it will depend. None of my clients went through that, process. What happened was, or what could have happened is that before the rate hike, if the client was approved based on a variable rate and they flew off and they had the final approval before the rate hike, then they were fine. But if there were conditions and clauses that this needs to be provided, that needs to be provided, after the rate hike, they might have not qualified because of the rate hike, and then there were still conditions on the financing, right? So if the final approval was received and it was closer to the closing time and all that, then it would not have impacted as far as the final approval was received. If there were conditions in the offer, then yes, it would have impacted, especially if they were on a variable term. The way I structured a lot of my deals for my clients were go with a 1 or 2 year term. We'll qualify you based on that so that even if variable changes, it does not impact your qualification. And the fixed at that time was actually less than 5%.
The fixed, you said, sorry?
Yeah, a 2 year fixed was around 4.8, 4.9, something like that. So the clients who took on that offer, they're like, yeah, we don't see variable coming down anytime soon. We're okay to lock in 2 year fixed. They're laughing at this point, right? They were able to close, everything went smoothly for them. But I can suspect for the ones that were qualified on a variable, and that will happen probably again. So if there are any pre-approvals or conditional approvals that is valid as of today, October 26th, this might not be valid. So my suggestion is get your final approval. Try to remove all those conditions so that you have the final approval, and another rate hike or another one in December will probably not impact you.
Yeah, good point. Good point. Because actually I didn't even realize there was one in October. I thought it was just one in December. So we're gonna do two. And I kind of feel the same thing as you. I feel like you're saying, I'm anticipating or running my numbers with there's going to be more rate hikes next year too. Just to, like you said, it's kind of worst case scenario. Might as well take that as the real scenario, because I feel like actually I personally feel that it's probably going to happen, to be honest. Maybe not as intensely as this year where it's just like boom 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 boom, let's get up to 5 for some reason.
Right. Yeah, I mean, it's very well a possibility. I think in this environment, everything is a possibility. Like
I know everything's so fluctuating, right? Yes. Like yesterday, I was actually just happening to read, which I found really funny because I thought the opposite. And I was looking into others, but there's like an article that TD thinks that the rates are going to go down next year. And I was like, are you crazy? I was like, I don't believe that. And, but again, who knows? We'll see. Obviously, see whatever it is. But I just found it really funny because at least in my mentality, or as an investor mentality, we don't want to take the best case scenario. And we rather like, okay, let's just assume that there's going to be some rate hikes and just prepare for that. Like you said, prepare for the worst. Yeah. And like you said, be laughing, right? Because for example, all my actually mortgages were all fixed. And so I heard like lots of people, getting like stressing about it because they went into variable. And like my mentality, at least behind it, was the interest rates were so low for me that I was like, are they really going to go that much lower? And if it does go that much lower, do I really care? Like I felt like I was cash flowing so much on where I was already that I was just like, I don't see the point in like pinching pennies over here to get like my extra monies on, so I went fixed. And but then I have one of them coming up in a few months, and I was just like, oh man. And it's quite a difference, right? It's like that if I do a 3-year term, I actually stay at least with the same amount, the same payment, obviously more interest going to the banks instead. But if I did a 5-year term, I was actually going to be paying more than I am now. And because I was thinking, I feel, again, personal opinion, I feel like this recession is going to probably last a little longer. So I was thinking, I'm going to do a 5-year term and just kind of blow through it. And just like, whatever, let's just let it happen. I at least don't need to stress about it. But now I'm kind of thinking I may do the 3-year term one instead. And at least my payments stay the same. Yes, I'm paying less to principal, but at least like that in 3 years, and I decide what to do next. So I may be doing that. We'll see. I'm like contemplating the meaning of life these days.
No, I think the short-term fixed will be a good solution. Especially in 2 or 3 years, you can reevaluate, and hopefully the rates will come down to normal at least. They won't hover over 5%. Even around 3% is a good number to go with. 3.5, anywhere around that, right? So hopefully in 2.5 years, what have you, they will start to come down, and then you kind of move into if you want to sell it or if you want to convert it into variable or fixed, what have you, and then make a decision accordingly.
At those times, yeah, 100% agree. But yeah, it was really funny when because all of last year I did flips. To be honest, I guess I did, and all my flips were they needed private money. They weren't, a bank would not fund these kind of things. So I realized I wasn't really that aware of what was happening and these like increases that were happening. To be honest, I thought we were like maybe at 3, getting into the maybe like the low 4s. And it was really funny when they're like, oh yeah, like 5 points. I think one was like 4.7 and the other one was like 5.2 or something like that. I can't remember. Somewhere in the range. And I was just like, whoa. I was like, where have I been? I was like, clearly I missed the boat. I was like, all these flips going on. I just like, again, right? I'm not going to pay attention to things that I don't really need to worry about because I'm just not there, right? So I thought it was funny. It was quite a hit. I was just kind of like, oh, okay. Clearly things are changing a lot more than I expected.
Yeah, they did. There were multiple rate hikes, and that too, like not with just 25 beeps. Some of them were like 75, one full percentage point, right? So, which is a huge number for a lot of people who are especially on a variable term, and especially for a variable term that did not have fixed payment type of schedule. I know one particular bank which kept on increasing your payments as soon as the rate hikes went up, right? As soon as it was announced. And it was a big difference. Like some of my clients who I'm helping were at a mortgage of 3,200 and then now they're sitting close to 5,000. That's like extra 2K, which is a huge amount and expected to go more, right?
Yeah.
So even if you want to convert into go with a variable 3 year, 5 year, what have you, I feel like if cash flow is a big issue, then going with a fixed payment might be a better option. Whereas if you have flexibility in terms of payments, then maybe stay with where you are.
I agree. I completely agree with you because it's exactly what you're saying, right? It's the worst case scenario. Like see if you can actually handle, I don't know, another 3 to 5% increase. I think, I feel like by the end of the year, I feel like maybe we'll be like at an extra 5%, who knows? But like see what you can do and see if it's definitely worth it. Because if it's not, then I feel like it's better to just be losing at, let's say, a fixed rate now than to kind of wing it and hope for the best and think, for example, like TD, things will be okay next year, like no interest rate hikes. It's like we're going to see the market go up and whatever. And if it doesn't happen.
Yeah. And that's what it is, right? Like, sure, we all hope and pray for positive things to happen, but always be prepared for something the other way around, right? Like it could potentially go, and it probably will go the other way around.
So curious, actually. So like that, if we're thinking like for the end of next year, again, like just your opinion, but just to give people, let's say, a guideline of what interest rate to use, what do you think by the end of next year people should be using? Like what do you think is like a safe number? I know we're not holding you to it, just your opinion.
Yeah, I mean, again, I'll tell you what other banks are predicting. So currently the overnight lending rate is about 3.45%, which takes the prime to about 5.45 in most banks except TD. TD does it slightly different. They add additional beeps to it. So let's say overnight rate is 3.45. We see another rate hike of at least 1% this year. So that's sitting at about 4.45. By next year, most of the banks are speculating anywhere between 4 to 4.5%, overnight lending rate. So see your numbers accordingly. It could be slightly more, to be honest. Again, it all depends upon how economy is reacting to so many external things that are happening in today's world, right? UK is predicted to have inflation of about 18% by early next year,
Yeah,
right?
I heard about that.
Yeah, finance minister just resigned, a few days ago, and they're in a complete turmoil, financial turmoil right now.
Mhm.
So hopefully that doesn't cross over, that doesn't have too many impacts, globally. But I feel like in today's world, we are so interconnected, we are so interrelated. All economies are kind of interdependent on each other. We just don't know what the trickle effect might be of things happening, right? So my suggestion or my recommendation is that if a renewal is coming up right now, within the next, 3-4 months, or you're planning on purchasing a property over the next 3 to 4 months, or you are in adjustable rate mortgage, then you really need to sit down, figure out your budget, and reevaluate your options. Go with a short-term fixed rate mortgage that locks you in just for 2 years. If you know that you're not planning on selling or flipping, everybody's answer is going to be different. Or you
100%.
feel or you feel that the cash flow is really tight, because of increased rate hikes every time, go with a fixed 2-year option. And like I said, we currently have a really good rate going on, and that's limited time. Like they can increase it at any minute, to be quite
Yeah,
honest.
probably in October, whenever the date is.
Yeah, I mean, they're hiking. As of last week, as of last Thursday, this rate was 4.99. So
Mhm.
just within a matter of 2-3 days, they hiked it up again by 2, because you have to understand how bond yields are working, right? So bond yields have been really volatile over the past few months, and recently over the past few days, it's not been great either. So all the banks have increased their fixed rates last week itself, right? And
Mhm.
that trend will probably happen again. Like they'll again increase those rates. It was expected to go down the fixed, but doesn't look like it will. So if people want stability, or they want to, I guess, cap out on their losses, or want to make sure that it won't go beyond this point, and want to be comfortable, want to have that peace of mind, want to sleep at night, then definitely go with a short-term fixed rate, lock it in for 2 years, and that's it. And then reevaluate. At least it gives you 18 months of time to kind of sit in peace and let things settle down till, things get better.
Question for you. You're talking about bond yields. I actually didn't realize that. So we have then two factors. The interest rate will also impact, and the bond yields will also impact the interest rates that the banks use.
So what happens is the fixed rates are dependent on the bond yields, whereas your
Mm-hmm.
variable rate is dependent on the overnight lending rate that's announced by Bank of Canada. Okay. So they
Oh,
both are kind of calculated in a slightly different way.
oh, okay. I didn't realize that.
Yeah.
And for bond yields, um, just curious, probably if you could talk a little bit about it. I don't, maybe the viewers don't really know very much about like what it is and maybe why it impacts.
Yeah, I like to keep things really simple. And bond yields are something that, government treasury bonds basically. And I don't have in-depth knowledge about that as well, other than I just know that it's related to the bond yields and so on. So I kind of just, quickly go through, okay, yeah, this is what the graph is showing. This is where the bonds were, a couple of days ago. And we're really seeing a lot of volatility in them. So I wouldn't be able to, talk too much about it. Don't want to misguide the listeners, but if you do a quick Google, you'll see how the fixed rates are impacted due to Canadian bonds.
Oh, okay. Actually, you can even find that the correlation
All the
between the two.
information, yeah, all the information will be there, or at least what's the correlation between them.
Oh,
Yeah.
okay. Yeah, that's good to know.
With the prime or with the variable rate, it's easy. It's dependent on the overnight lending rate, which we know is announced by Bank of Canada. During COVID, it was super low at 0.25%, because you know basically Bank of Canada wanted to increase the demand per se, because people were scared at that time. They wanted to make the lending easy for people so that at least some transactions happen, because everybody was just sitting at home, not really spending money on travel, not really spending money on restaurants and all that stuff, right? So they wanted to stimulate the economy. But then what we saw was inflation really took off. And we were seeing that even last year, that inflation was sitting around 5%, which is really outside what Bank of Canada has been mandated. So Bank of Canada is expected to manage the inflation between around 2% per se. And it has been like that for a number of years. But last year, when it spiked at about 5%, Bank of Canada said that, oh, it's just transitory due to COVID related issues. It'll probably settle down. But guess what? Nothing happened in January, February, and then they finally took an action in March when they spiked up by 0.25%. And then they have been making, taking drastic steps in order to control the inflation, because even in February is when the Russian-Ukrainian war was, it started. So that, and even the Fed started making announcements, and they just followed the lead towards it.
Yeah, interesting. And oh, so you followed like the trends for the bond yield though, right? Like
Yeah,
do you know why it's going so, like, it's just we don't know why it's so volatile?
yeah, it's probably a number of factors behind it. I don't know in-depth knowledge about that area, but yeah, there are a number of factors, I'm sure, behind it, why it is volatile.
Interesting. Anything else you'd like to share with the viewers related to that? Any other changes that you've seen, or you foresee? Like, do you even see anything, the banks changing things like in the next, like for next year, or any kind of change?
It's too early to make any assumptions about what they might do. In UK, I know what they had done was they dropped the stress test, right? So they literally eliminated that. Will that come to Canada? I don't know. We'll see.
Oh, wow. But that's huge.
It was
So they're
big.
just going to, well, so they're going to, okay, so but it would still be on your TDS ratios and all that, just no stress test.
Yeah. So basically, if you were being qualified for, say, for example, at 7.2%, that's the going rate right now. Now, if they eliminate the stress test, then you'll qualify on 5.2%. What that means is that now your affordability goes up. Your affordability pretty much comes back to normal, comes back to, pre-increase era, which was in March, pre-March time period. Actually, no, pre-July time period. So if that happens, then it will increase the affordability of a lot of people, and it will help, purchasing power and all that good stuff. But then again, like, I wouldn't necessarily suggest that if you have been approved for more means that you should buy for more.
100%.
Because we are all expecting a recession, or we might be even in a recession. We just don't know that we are in a recession. So I would say that be frugal around this time, right? Like really try to understand your budget first of all. See how much you're making and where things you're spending. Try to cut back on some extra discretionary spending. And this might be different for everybody, obviously, right? Revisit your investments. Like, what's your investment strategy during this time? Are your funds just sitting in a checking account and not doing anything? At minimum, at least put them in a high savings account. You'll be easily able to get around 4% these days. If you don't want to invest per se in stocks and you feel like it's really volatile right now. But if you are willing to take slight risk and you have a little bit of extra cash available, and this is beyond, if you, first of all, you should have some liquidity at least for 3 to 6 months, right? Like have that emergency funds available, that you never know, like you might see some kind of restructure happen at your job, so you might end up either losing, not to scare anybody, but that's a fact, that's what happens in recessions. Like people are let go and companies restructure, they find various ways of cost efficiencies and all that stuff, right? So I would say, first of all, plan for your emergency fund for at least 3 to 6 months. If you have any extra cash kind of sitting, then put it in high savings. If you have a bit of flexibility, or you can take a bit of, not even risk, like I would put in simple things like dividend paying stocks. Say, for example, I'll pick an example of Scotiabank. It pays 6%, 5 to 6% of yield on your fund. So if you put $10,000, you're getting $600 in a year, or however they structure it, right? Whenever they announce it. Enbridge, utility companies, they're not going to go anywhere. They're backed up by solid government funding and all that, right? So put your money towards yield stocks that are paying you some kind of dividend at the end of the day to help you with the cash flow, but also parking it and saving, safe investment, so that even if you need to liquidate over the next few months, you wouldn't have any issues doing that, right?
100%.
And then finally, obviously, if investment property makes sense, you have that cash available. You are an investor, you know how things work during a downturn, and you can budget for things going haywire. And then definitely look into opportunities, because this is the time to actually make money.
Yes. And I like the point that you made. I just want to re-emphasize is having the cash.
Yes.
This is not the time to be like, I want the full thing to be loans. Like this is the other way around. This is probably just have a first mortgage and everything else is cash. Like being cash heavy right now is a great asset for, like you said, great opportunities are definitely going to be coming. And those people who have the cash ready to make those jumps will probably be successful at it. But it's like, if those great opportunities are there, but you're doing it all in loans, like that could be detrimental. Just because it's a great opportunity doesn't mean it's a great opportunity when you're all fully indebted.
If you're highly leveraged, then it might not be the right time to do it. Or at least, seek for a coach, seek for a mentor like yourself, pick somebody's brain and see if you're thinking, you're checking your blind spot, basically, right? You're not just going the straight way. So that would be my recommendation. Like, maintain your liquidity. If there's an opportunity that comes up, definitely look into it, get it, but have somebody who is kind of seasoned in what you're investing in.
100%. And even this is the time, because this is something also I noticed in the investing world, that people are just throwing money at things. And I think this is the time for people who are just those passive investors that have cash, is to really get to know either who your current partners are, in the sense of like what kind of deals they actually like this is the time to actually, and even like as passive investors, I feel like, to even understand how to analyze the properties and make sure that what your partners, active partners, are doing are actually makes sense for you as a passive investor. Because It's not like last year and 2 years ago where you could just throw money at anything. Although I can tell you that I saw people losing money even last year and 2 years ago. So I mean, people shouldn't be throwing money, but I mean, at least there was I felt like the percentage of people throwing money was probably like at least the percentage was like, let's say 20% were losing, but at least the full 80% were winning, which again, it kind of gives false hopes for those passive people. This is not the time because it'll probably be the other way around. If you're like a passive one throwing your money, probably it's going to be like 20% of the people that do well and 80% that will just like flop and so it's definitely just take the time to understand. And I think, to be honest, right now is a great time to start understanding like exactly how to analyze those properties and actually understand like what is a good deal, because like that, I think in the coming months, we're going to start seeing, or sometime in the middle of next year, we're going to start seeing some really good deals coming up. And so you have the time right now. Take the time right now to do that analysis like that, like just talk to the community, see what other people are doing, and just really get an understanding of how the market is. And like if you don't like doing it, probably park the money for a while. Because if you don't like doing the analysis, I know it sucks, but or either like find someone that you can trust that will take care of the money for you. But if you can't find that and you don't want to do the analysis to find the right people to get into, then maybe like you said, the other investment opportunities are probably better at this time. What do you think?
Yeah,
what I said?
100% agree with that. I think you really have to research, do your due diligence in terms of who you're investing with, what kind of project it is. So it requires, and it's not just in this time, I feel like it should have been in every investment that you're making. It's your hard-earned money, and your money won't work with you unless you have worked for it, right? Like you have to make sure that wherever you're putting, at least you have done your due diligence. Sure, things can go sideways anyways. It is an investment at the end of the day, and investments sometimes do fail, but making sure that you took all the measures that you should have taken in terms of consulting, like I said, somebody who has done something like this before, picking brains of people who are in and around you, surrounding yourself with people who do this on daily basis and who can rip it apart. What the shit are you investing in? This does not make any sense, right? Like, you need to know those people, and you need to have those people by your side so that you kind of stay away from making those mistakes, which I'm sure most of us have made at some point, and we have learned from our mistakes, but
at least learn from our mistakes, right?
Learn
from our mistakes so you don't have to deal with it.
Yeah, exactly. And take advantage of that. There are too many people out here, including both of us, who have made some ridiculous mistakes earlier in our investing careers. So pick our brains, like pick people's brain, and go to meetups, like go to networking events. And you and I were just talking before going live that there's so many events happening these days.
There's definitely not. There's so much in abundance. Like if you miss one, next week there's another, probably two.
Yeah, I'm already going to 2 or 3 of them, including one of yours this week. So it's like there's a lot of information out there. You just need to find the right partners, right mentors, people who have done this stuff before, and then make decisions accordingly. More you can educate yourself, more power you will have in terms of finding the right deals and making that confident decision ultimately, right, when the time comes for taking that action. So I think knowledge is great, but having a strong team is what will help you. And then finally, leaving that analysis paralysis phase and just jumping into something is how you will learn, or will find something that suits your requirements.
100%. Supriya, thank you so much for coming on. It was great to hear your point of view and hear about what you had to say. And so if you like what you hear, feel free to add her to your friends list, chit chat with her. She loves chatting with everyone.
There you go. That's a podcast too. I love chatting with people. So yeah,
check out her podcast. 100%. So feel free to follow her. And same thing, if you like what you hear, feel free to follow me too. So thank you so much, Supriya, for coming on.
Oh, you're very welcome. Thanks for having me.
No problem. Bye, everyone. We'll see you on the next episode of On the Flip Side. Bye.